Hi everyone, in this video we're going to continue talking about retirement planning and tax planning. Specifically, we're going to look at something called a spousal RRSP. Remember from a prior video, we met a taxpayer by the name of Parm. Hi Parm. Well, in this video, we're going to introduce Parm's common law partner, Chamath Lingam Palahapatia. Chamath likes to go by CLP for short. Parm is very successful, and as a result, Parm has a lot of taxes payable. In a prior video, we talked about how Parm could reduce taxes payable by contributing to an RRSP account in Parm's name. Well, Parm can also contribute to an RRSP account in the name of Parm's spouse, or in this case, of Parm's common law partner. This here is an RRSP account registered to Parm's common law partner. And as the contributions and deductions go up, Parm's taxes payables goes down. And the opposite is also true. And this might raise a question for you. You might be thinking, well, how is this any different from a regular RRSP? I'm so glad you asked. Parm is very successful, so even in retirement, Parm could have income from different sources such as investments, real estate, or crypto and Bitcoin, or whatever it is that Parm has. All of these things could be generating income for Parm in retirement, and thus taxes payable continues to be high or relatively high for Parm. Imagine now that Parm had also been contributing to an RRSP, and all of that income would be going to Parm in Parm's name. This would only serve to increase Parm's taxes payable in retirement. But that's not what Parm did. Parm anticipated having these other sources of income in retirement. So what Parm did instead was contributed to a spousal RRSP, meaning the RRSP eventually started to pay out Parm's common law partner. And Chamath had some taxes payable. Notice now the overall taxes payable for this couple as a family unit is lower than if all of the income was to go directly to Parm. So this type of RRSP can be a very effective way of income splitting in the future. That's a high-level overview of what a spousal RRSP is all about. Before we try to look at a case with actual numbers and dates, let's quickly remind ourselves of what you learned about in your lecture when you had to review the Income Tax Act and some of the key provisions. As always, the key provisions are covered in detail in your lecture, but in the Income Tax Act, we do focus on Section 146, subsection 5.1, 8.3, and Section 56, subsection 1, paragraph H. 146 5.1 is basically where you'll find that a taxpayer can deduct payments that are made to a plan that is registered in the name of a spouse or common law partner. This is where you'll find the income attribution provision. Essentially, if the registrant makes withdrawals from a spousal RRSP and contributions were made by the spouse or common law partner in the current year or preceding 2 years, the following will be attributed to the contributing spouse or common law partner. We're going to look at the lesser of the withdrawal or the total of the spousal contributions in the 3 years will be attributed to the contributing spouse or common law partner. Let's take a look at an example, and first we'll look at the case facts. With these sorts of situations, I always find it helpful to draw a timeline. This timeline covers 20x0 on the left and goes forward 10 years to 20x9 on the right. In January 20x9, Janet's RRSP account with TD Bank had a balance of $50,000. But how did it get up to $50,000? Well, Janet's husband Bill established this spousal plan in 20x0 with an initial deposit of $20,000. Remember, even though the contribution was made by Janet's husband, the registrant is Janet. Next, Bill contributed $1,000 in X6 and $1,000 in X7 and nothing else. And those are those two contributions shown there. We can now remove some of the other details to just focus on the contributions right now. We can see that we have contributions in 20x0, 6, and 7. I'll indicate these with a yellow dotted line going into the year. I'll have the line kind of going into the middle of the year because we don't really know when in the year it happened. It doesn't matter as long as we know what happened in the year. Before the end of January 20x9, Janet withdrew $20,000 from this RRSP. I'll indicate the withdrawal with a dotted red line closer to the beginning of the year, in January 20x9. A withdrawal of $20,000 in brackets. In May 20x9, Bill established a new RRSP account for Janet and deposited $10,000 in a Royal Bank RRSP account. And because it went to a different bank altogether, I'll indicate that with a blue line for now. But as we'll see, it doesn't really matter that it went into a physically different bank account with a different bank. The registrant is still Janet, so this will still be considered a spousal RRSP. So we'll turn that dotted line yellow just to indicate that it doesn't matter. The registrant for all of these accounts is Janet. Now let's consider the tax consequences of this withdrawal in 20x9. A withdrawal of $20,000 has been made from an RRSP account, and we know from our studies that amount needs to be included in income. The question becomes, in whose income, Janet or Bill? This is where we look at ITA 146 subsection 8.3. Essentially what you need to do is you need to look at the year of withdrawal, or 20x9. I'll change the color so it's very clear to you. We also look at the two preceding years, so the year of withdrawal, the current year, and the two preceding years, x7 and x8. We then look to see were any contributions made in those years. And sure enough, there were the $1,000 in x7 and the $10,000 in x9. Those amounts are less than the total withdrawn, so we allocate those to Bill. The remainder, $9,000, is allocated to Janet. The amount left to allocate then is 0. And that's all I have for you in this video, everyone. So thanks for watching and happy studying.